Okay, and welcome back, students who are taking Math for Business and Finance and Math Applications. And we are in video 4 for Chapter 16, the theory videos for how to read, analyze, and interpret financial reports. So, in the previous video, we talked about the formatting of balance sheets. So in this video, we're going to talk about the formatting of the income statement. Okay. Now, again, I'm going to highlight here. When you're looking at an income statement, you're not going to see these here notes right here or any of the notes over here. And you're not going to see these references here, okay? Remember, these references were just for when you're reading the textbook in order for you to be able to follow along and know what they're talking about, all right? So it would say A is our gross sales, and, and then you're able to look at the income statement to actually see, this gross sales, all right? So when you strip out all that all of this other stuff, okay, now you have a basic as to what an income statement looks like. And unlike the balance sheet, where you could have the information presented horizontally or you can have the information presented vertically, with the income statement, the information is presented vertically. All right, you don't get horizontal. You don't put revenues over here and expenses over here. No, it's revenues here, expenses here, and then you end up with your profit or loss down here. Okay. Next, and again, the income statement, all financial statements are covered under generally accepted accounting principles, GAAP principles. They dictate how things are presented because they have a meaning. That's all part of the analysis and interpretation of financial statements. So I'm not going to get into a whole lot of that. Just realize that things do have to be presented in a specific way, and as you progress further in your education, you'll come to understand why, and you actually use it to be able to do the work. All right. But as you can see, here we have a heading. All right. And notice it says here, the income statement is for a specific period of time. Okay. And that period of time is called an accounting period. Okay. Now the accounting period, the most common ones are monthly, every 4 weeks is another one, depending upon the business. If notice that there's a difference between monthly and 4 weeks. Monthly means you have 12 accounting periods throughout the course of a year. If they're divided up into 4 weeks, you take 52 weeks divided by 4, means you end up with 13 accounting periods in a year. Okay. Some businesses use that because of seasonality. Okay. It just fits better for them to be able to, like, for example, hotels have a tendency to use every 4 weeks as their accounting period. You can see accounting periods, quarterly. You can see them semi-annually. And you can also see them yearly. Now, whereas the balance sheet, let me back up in the slide here, the balance sheet was as of a particular date, meaning on that day. And the reason why it's on that day is because it went from the very day that the business started up to that particular date. With the income statement, it's for a specific period of time, depending upon the accounting period. Now, I just showed 5 different accounting periods, but we're going to kind of like mostly stick with monthly because it's the easiest to work with when it comes to learning how to do all of this. So what does this mean? Well, if we're looking at a monthly accounting period, that means at the beginning of the month, all of our revenue accounts and all of our expense accounts all of these balances are 0 at the beginning of the accounting period. They're all 0. Okay, and then during the entire course of the accounting period, so this here is for the month ended December 31st. Now notice it says month ended. Okay, so it's kind of like telling you what the accounting period is. If this was quarterly, meaning every 3 months, it would say for the quarter ending December 31st. Or if it was yearly, for the year ending December 31st. Okay? So that terminology lets the person know how long the accounting period is. But during the accounting period, it starts out with a zero balance. So if this is for the month ending December 31st, our accounting period went from December 1st, 2014 through December 31st, 2014. And so the information that's on this here income statement is only reflected between those dates. Now granted, this business may have started 1/1 in the year 2010, okay, but any of the information between 1/1/2010 and the beginning of this accounting period is not included on the statement. And the income statement reflects the operations of the business. Okay, whereas the balance sheet showed the financial position of the business. Okay, that's why cash. I mean, it doesn't matter how much cash we have month to month to month. Okay, because that's the financial position. We want to know just what our cash is on the balance sheet. But when it comes to the income statement, we want to be able to look at the different periods in order to be able to compare, right? So I have January of 2013, February of 2013, March, April, all the way through to December, right, 2013, and then we have all of those periods to 2014, right? Well, if this is December 2014, I want to be able to see the exact, be able to make a comparison with what happened in December of 2013. And so therefore, it's chopped up into accounting periods. Also realize that it's the operation, since it's the operations of the business that's reflected on the income statement. What are we talking about here? Well, when it comes to the operation of the business, we're talking about, making sales or revenue, and what are our expenses. That's it, right? And whether we're profitable or we took a loss at the end of that period. Okay, so for the income statement, it's the operation of the business for a period of time, right? And when we get to the end of December, all right, which is where we're at, when we go to the next month in January, all of these balances here that you see, they're all going to be reduced to zero. So it starts out fresh again. If I ran an income statement for January 1st, 2015, when the business first gets opened, all of these balances would be zero. And at the end of the day, okay, if I had sales, well, that would have affected the sales account, but most likely I wouldn't have a plumbing expense. I wouldn't have an insurance expense, okay? Especially the plumbing one or the insurance, because why? That didn't occur, so those balances would stay zero, okay? Now, with all of that said, let me erase all of this. This here, on the most simplistic level, an income statement is revenues less expenses. And that gives you a profit or loss. Okay, but that isn't very helpful information. Okay, so what ends up happening is we create additional accounts. They're called ledger accounts, and that's beyond the scope of this here book. But what happens is it expands our revenue and expands our expenses so that we can do analysis. When we look here on this income statement, we have revenues here, and we see a gross sales, okay? And I could have just had one account called gross sales and just left it at that, right? So anytime I'd have a sale or a return or a discount, it would be put into the gross sales. But that doesn't help me, all right, as far as analysis is concerned. Because why? I might want to be able to track returns and allowances. I want to know how much is being returned, okay, if there's a problem, or how much I'm giving, away in discounts, okay. So I can create additional accounts, and then I could take the revenue, the gross sales less the returns and allowances, and our sales discount in order to know what my actual net sales are, my actual amount, right? As if I only had one account called gross sales. But by having additional accounts, I'm able to look at this information and I'm able to analyze it. So we expand, right? We expand to include a lot of this other information. Right? Now, I'm not going to get into this because this is talking about purchases and we end up with a gross profit. But one of the first steps that ends up being taken in the expansion of the revenue section is to be able to say, okay, here's my sales or my revenue, but I also want to know what my cost of goods sold is so that I know what my gross profit is on the sale of those items. Think of it like this. I buy a table for $100, okay, and I sell it for $500. Oops, let me erase that there. I buy a table for $100 and I sell it for $500. That means my gross profit is $400. That's important. I have to know what my gross margin is because I might not be selling it, for enough money. Why? Because from that gross profit, now I have to take out all the rest of my expenses in order to get my profit or loss. Okay? If I'm not selling the table for enough money, I'm not going to be able to cover my expenses. Right? So now you just saw how my revenue just got expanded into sales and cost of goods sold, ending up being gross profit, which is what we're looking at here on this financial statement. Okay, and once we have our gross profit, now we can look at expenses. Well, yeah, I can have one account called an expense account, and I could put all of my expenses in that one account. But what good is that going to do for me? Okay, I don't know how, if I put everything into the expense and I'm looking at my total expenses of $4,630, okay, I don't know what makes that up. I don't know how much was for payroll. I didn't know how much was for utilities. I don't know how much was for rent. All I know is that my total expenses was $4,630. Well, we expand that out. We create additional accounts, right? We create additional accounts right here, okay, so that we can itemize, categorize the different expenses. So when I'm looking, I can say, oh yeah, my total expenses was $4,630, but $2,200 was for salary. Well, is that too much? Or, $1,300 was for insurance. Well, maybe I had an insurance payment this month, but I don't have it in the next month. All right, I'm able to do more analysis on and track my expenses a lot better. Okay, so now what we have here is we have, for our revenues, right, we had our sales less our cost of goods sold, which gave us a gross profit. And now we take our expenses, okay, and we itemize those expenses so that, let's just say, I had one for 200, I had one for 25, and I had one for 10. So that's what, 235. So 235 from the 400 means I end up with like $165 in profit, right? And that's my bottom line. So I know how the operation of my business worked for that period of time, whether I was profitable or not. Okay, and realize that I'm talking about sales and expenses. I'm not talking about finance. I'm not talking about the financial position of the company. Yes, this bottom line, all right, this 6,316, or in my example here, 165, that's profit that we had made in the business for that period of December. Well, when you get into more in-depth in accounting, what ends up happening is that amount, remember, we fold it, we start the accounting period at a zero balance, so that those numbers have to disappear. Well, where do they go? They have to go somewhere, and where they end up going is retained earnings here on the balance sheet. So at the end of the accounting period, that $35,000 would increase or decrease depending upon how much profit or loss I had, and that's that interpreting the financial statements. It's not something that's easily learned in a quick overview. Right? So I realize that for some, this may just raise more questions, because remember, we're looking into down the rabbit hole here. Okay, we're taking a peek, and the more you look, the deeper you can go. Okay, and that's exactly what we have here. So you have to make there's the information can only be presented in small amounts, or by certain concepts. And with Math for Business and Finance, as far as reading the financial statements, okay, in the textbook, this is what's considered reading the financial statements. But hopefully I've given you just a little bit extra so that you have a better understanding of what you're actually looking at, and you're not just memorizing what's on the statement and saying that this is exactly the way it's supposed to be, because that isn't the way it's supposed to be. They all follow the same accounting principles, but the information can be presented in different ways. But by understanding a little bit of the structure, a little bit of the framework, it will give you a better idea. And with that said, for those that want it, okay, underneath the business group on the left-hand side on the student community, there's a section called financial accounting, which is after I get done with this Math for Business, I'm going to be working more on the financial accounting. But right now there's a bunch of videos out there, maybe 15 videos or so, about the framework of accounting and how to think about it and how to build a thought process in your head, so that as you work through information, you have some ideas to where you're coming and where you're going. Okay, and for those that want to, go ahead and check out those videos. By no means are they part of this subject. That's just for those that want that additional, or anybody who is going to take financial accounting, or whether you're a business manager or marketing, finance, anybody in the business curriculums, that's where you're going to go when you hit those subjects. Okay. Right. With all of that said, again, pause, rewind, watch the videos again, and if you still don't understand something, definitely contact an instructor, because this is stuff that you're going to need to know. And if you don't understand it up front, it's like having Swiss cheese. You have holes in these cheese, and if you don't plug up those holes later on, you're going to have a problem. And if you didn't plug up that hole, well, then you're already starting out, in the wrong, because you just can't get the right answer, because you don't have that background information, all filled in. Okay. So with that said, I will see you in the next video.